Welcome back to Reg Talk UK, the podcast that helps UK banking professionals stay sharp, stay informed, and stay ahead of regulation. Happy New Year! This is our very first deep dive of 2026, and, well, if the first week is anything to go by, we are in for an absolute shocker of a year, particularly on the geopolitical risk front. I'm Alex.
And I'm Jamie.
We have had a week defined by, an instant, high-octane geopolitical event that has triggered a compliance crisis for every UK sanctions desk. And domestically, we've crunched the numbers on record-high account closures or debanking, and it's revealing a worsening conflict between financial crime rules and, consumer duty.
Right. And on top of that, the FCA has been delivering these really powerful signals on accountability, starting with some significant fines for former directors of the collapsed giant Carillion.
So for you, listening in compliance, risk, and strategy, what's the immediate takeaway?
Well, the stakes couldn't be higher. The capture of Nicolas Maduro has created a real-time, high-stakes compliance gap. And this is immediately crystallized by the fate of that $1.4 billion in Venezuelan gold sitting frozen in the Bank of England's vaults.
And the debanking data.
That just proves that operational compliance and conduct are now functionally the same thing. Every decision about closing an account is now simultaneously a regulatory risk and, just as importantly, a reputation risk.
Okay, let's unpack this. We have to start with the biggest, most urgent, and frankly most dramatic compliance event of the week, the Venezuelan crisis. This is a geopolitical shock that went from, a theoretical risk to just operational chaos in a single weekend.
The facts read like something from a thriller, not a compliance bulletin. On the 3rd of January 2026, Nicolas Maduro was captured by U.S. Special Forces in Caracas. He was extracted from the Fuerte Tiuna military complex and is now detained in a Brooklyn facility facing narco-terrorism charges.
Wow.
Yeah. The operation, codenamed Operation Absolute Resolve, was exceptionally sensitive. They even eliminated over 30 Cuban military and intelligence personnel who were guarding him.
And that immediately creates a massive political and legal vacuum.
A huge one. In Caracas, the immediate reality saw Vice President Delcy Rodriguez sworn in as interim president.
Okay, and here's the critical point for UK firms, isn't it? Rodriguez is herself already a designated target of international sanctions.
Exactly. And this is where the compliance fallout for the UK becomes a perfect storm. And it's centered entirely around London. The core asset at stake is 31 tons of Venezuelan gold, currently valued at approximately $1.4 billion.
And it's all frozen in the Bank of England's vaults, has been since 2018.
That's it, a massive physical asset gold bars stuck right in the heart of the city.
The UK legal position on this was already difficult, even before the capture.
It was a mess. After those complex Supreme Court rulings, it all hinged on who the government recognized as the legitimate authority. The UK previously recognized Guaido's parallel government, which is what allowed the courts to block Maduro's access.
But that structure dissolved back in December 2022.
It did. So now, with Maduro detained and the interim president, Delcy Rodriguez, being sanctioned, the UK effectively acknowledges neither side as having clear authority over that gold.
So if you're a UK bank, maybe processing correspondent banking or even minor trade finance, what is the clear operational risk here?
It's total uncertainty. You have no idea who is a valid transactional counterparty. That's why Venezuela remains classified as a high-risk jurisdiction for UK clearing, under the Wolfsburg Group principles. But the immediate threat, the one for this week, is sanctions divergence.
Explain that.
The U.S. may move quickly to ease sanctions to support some kind of transitional government in the Caracas. They might undesignate some entities or figures.
But the UK designations, especially on individuals like Delcy Rodriguez, they would remain in full force.
That's the exact danger. A transaction that becomes perfectly permissible for a U.S. firm to process could instantly land a UK firm in a serious breach of our autonomous regime. This divergence forces UK firms to operationalize a conflict between U.S. diplomacy and their own binding legal obligations.
That sounds like a monumental task to screen for in real time.
It is. This is a critical window. The call to action is immediate. Firms must prioritize system preparations for the January 28th migration to the single sanctions list.
The new consolidated UK framework we've been talking about for months.
The very same. You must be QA testing your screening filters now to make sure your systems are flexible enough to handle this new unstable reality.
Okay. We've seen the global political risk. Now let's bring it home, because the FCA is connecting the dots between corporate accountability and consumer fairness. It started with a powerful reminder of responsibility at the top. On January 7th, the FCA fined 2 former finance directors of Carillion.
Yes. for their part in misleading statements about the company's serious financial troubles before its collapse. This is a huge statement about accountability.
The fines were pretty substantial.
They were. Richard Adam was fined £232,800 and Zafar Khan £138,900. And the essence of the breach was a failure to act with integrity. They knew how bad things were, but they failed to reflect that accurately in their announcements.
The FCA cited breaches of the market abuse regulation and the listing rules. Steve Smart at the FCA was blunt, wasn't he?
He was. He said, those in positions of responsibility have a duty to keep the market accurately and adequately informed.
And that duty links directly into this ongoing storm around consumer conduct, specifically what the press is calling the debanking epidemic.
Yes, and we have new figures that just confirm how severe this is. UK banks closed an estimated 453,230 accounts for financial crime reasons last year.
453,000. I mean, that is an astonishing number.
It is. It's a tenfold increase since 2016-17 and an 11% jump on just the previous year. And what these figures really show is the impossible regulatory tightrope that UK banks are walking.
How so?
Well, on one side, you have stringent anti-money laundering rules, tightened in 2017, which legally prevent banks from telling someone the specific reason for a closure if they suspect crime.
So firms are legally prevented from giving the very explanation consumers are demanding under consumer duty.
Precisely. And on the other side of that tightrope, since October 2024, you have the new rules requiring mandatory reimbursement for authorized push payment, or APP, fraud victims. That drives a much lower risk tolerance. If an account looks even slightly suspicious, closing it preemptively reduces your risk of being fined by the FCA and having to reimburse millions in fraud losses.
So the public outcry, often focusing on cases like Nigel Farage's, is about the unfairness of sudden closure without explanation.
Of course. And the FCA insists that fighting financial crime, which they say is 40% of all UK crime, is a priority. But at the same time, they demand firms act proportionately and treat customers fairly. And that scrutiny is real. Just look at the $44 million fine levied on Nationwide back in December 2025 for ineffective warning systems.
And that wasn't just about catching one criminal, was it?
No, not at all. It was a clear warning that the FCA expects automated, scalable risk detection. They referenced a case where one customer received $27.3 million over 13 months into a personal current account without being flagged.
So the proportionality risk sits squarely with compliance teams. You have to prove why you closed an account, even if you can't tell the customer the specifics.
That's the nub of it. And while new rules are coming to require 90 days notice and explanations, they only apply to accounts opened after April 28, 2026. And, crucially, they explicitly exempt cases where a bank is complying with AML obligations, so the tightrope remains.
We're seeing that regulatory net tightening elsewhere too, aren't we? Specifically motor finance. The FCA opened a formal enforcement investigation into a claims management company, the Claims Protection Agency Limited, on the 5th of January. This feels significant.
It's very significant. The investigation is focused on serious concerns about their advertising and sales tactics, things like pressurizing signups, misleading customers, and the FCA publicly said this action met the exceptional circumstances test to protect consumers and prevent widespread malpractice.
That sounds like the regulator is using this investigation as a highly visible warning shot.
It is the final warning shot. It's coming right before the FCA publishes the final rules for the proposed motor finance consumer redress scheme. The consultation closed in December. We expect final rules, which will likely require huge provisions for customer redress, in February or March. If you're in motor finance lending, the regulator is telling you very loudly to get ready now.
If you're finding this useful, don't forget to follow Reg Talk UK on Spotify or subscribe on YouTube. It really helps us reach more banking professionals like you.
Shifting focus now to future strategy and regulatory overhaul, which is going to have a massive impact on the pension and wealth management arms of the sector, the value for money, or VFM, framework.
This represents one of the biggest strategic shifts in the UK pensions market in a long time, doesn't it? A move away from focusing purely on cost.
Absolutely. The FCA and the pensions regulator just released the second consultation paper, CP261. And the goal is to enforce a fundamental shift from evaluating low cost to demanding proof of holistic value for savers.
So what's the biggest operational change firms need to prepare for?
It's the introduction of mandatory disclosure for what they're calling forward-looking metrics, or FLMs. These are things like expected 10-year net returns, which have to be considered alongside historical data. It forces providers to, well, to put their money where their mouth is regarding their future investment strategy.
So you can't just present past performance anymore. You have to justify your competitive strategy with verifiable future assumptions.
Exactly. And the accountability is built into the cost structure. Firms have to get third-party advice on these FLM assumptions. This step basically acts as an audit trail, an independent verification of the strategy. It turns VFM from a reporting exercise into a regulatory stress test.
I see. And what happens to schemes that don't measure up?
Well, there's a new 4-point rating system: red, amber, light green, dark green. Red-rated arrangements will be required to transfer members out, so expect major market consolidation driven by data that will be submitted to a new central VFM database. It's going to expose underperformers immediately.
Speaking of frameworks and data, we also saw a major technological milestone this week, didn't we? Something that moves beyond just white papers. On January 7th, Lloyds Banking Group, working with Urcax and the Canton Network, completed the UK's first gilt purchase using tokenized deposits on a public blockchain.
This is a huge deal. It's a global sterling debut for tokenization in a highly regulated financial market. They successfully issued digital representations of sterling, the tokenized deposits, and then used them to purchase a tokenized gilt security.
And what's the practical, real-world benefit of that for a corporate client?
Instant settlement. Because the cash and the asset are on the same ledger, the exchange is atomic and instantaneous. It drastically reduces counterparty risk, and it frees up liquidity that would normally be tied up in T+2 settlement cycles. It's a massive step towards operational efficiency.
Right. And finally, let's briefly touch on macro risk. We saw the symbolic move by the Debt Management Office canceling, what was it, $607 million of government debt using the 100-year-old National Fund.
It's a lovely historical anecdote cleaning up the books, but it's purely symbolic when you put it against the UK's total debt, which is now over £2.8 trillion.
So what's the real macro concern this week?
It's a warning from S&P Global about a projected 10 million-ton global copper deficit by 2040.
Copper. Why is that relevant to a banking and compliance audience?
Because S&P is calling it a systemic risk to global industries, to electrification, and to economic growth. Copper is the foundation of the energy transition.
Right.
A massive looming deficit will inevitably lead to elevated and highly volatile commodity prices, and that directly impacts asset valuation, corporate debt, and financial market risk across the entire economy. It's a long-term problem that needs short-term strategic attention. Okay, so to quickly summarize the action points from this week for your legal, risk, and compliance teams.
Go on. First, on sanctions and geopolitics.
The Venezuela crisis is an immediate stress test. Update your systems now for that January 28th single sanctions list migration and prepare for that very real risk of U.S.-UK sanctions conflict.
Right. Second, on conduct.
The FCA is tightening the net. The debanking data means compliance teams have to prove proportionality in every closure decision. And separately, that motor finance investigation is your final alert to provision for a major consumer redress scheme coming in Q1.
And finally, strategy.
The VFM framework. It means higher costs for strategic planning, that mandatory third-party advice. But it promises market consolidation. You need to start preparing for that central data submission now.
This week's news has been a sharp reminder that global political instability and domestic regulatory crackdown are now running in parallel.
They are. But consider this. If the UK banking sector is adopting new digital structures like tokenized deposits to instantly reduce counterparty risk on assets like gilts, why are we still relying on the same sort of 100-year-old strategic investment models for pensions and wealth, despite the VFM overhaul? The speed of operational innovation is leaving the pace of strategic oversight far behind. And that, I think, is the ultimate risk you need to assess this year.
That's all from us this week. Thanks for listening to Reg Talk UK. Until next time, stay sharp and stay compliant.